Part-time traders who try to trade less almost always fail within a week because their process has no structural enforcement. No amount of trading discipline fixes a design problem. In January 2017, I planned to take 2 trades and took 5 because nothing in my process stopped the third trade. I built a hard cap that year and I averaged 2 trades a month for 5 years. So I'm going to show you the 3-part constraint drill that makes overtrading structurally impossible even when your willpower has already failed. Every trade less promise breaks the same way because a valid looking setup appears and nothing in your process refuses it. For decades, commercial airline pilots were expected to judge when they had flown enough, and accidents kept happening because pilots were supposed to self-assess fatigue while performing the activity that caused it. So aviation regulators stopped asking and imposed hard numerical caps on flight hours. The number said stop and the pilots stopped. Fatigue-related accidents dropped because the cap made the dangerous flights structurally impossible. Every month, you promise to take fewer trades. And every month, the market presents a setup that feels too good to refuse. The fix is what I call the slot cap. It's a hard numerical ceiling on the number of trades you take per month. Pick a number. For most part-time traders on a single market, 2 is the right starting point because it forces every trade to earn its place. Write that number down, print it, and put it next to your screen. The rule should be absolute. When your slots are full, your trading month is over. No exceptions, and unused slots never carry over. At 1% risk per trade, just 2 extra losses a month bleeds roughly 20% of your account per year on trades that your own rules would have refused. The number does the refusing for you. When a setup appears after you've used both slots, you don't need to decide whether it's worth taking because the decision is already made. And that's the point, because the moment you are deciding whether to take the third trade is the exact moment your trading judgment is least reliable. I don't chase mediocre trading setups. I wait. And the cap is what makes the waiting non-negotiable. But the first time I capped myself at 2 trades, that is January 2017, I took 5. The cap was written down and the number was clear. And I still blew past it because it turns out a number on paper only works if something forces you to respect it. I had no way to qualify which setups and those 2 slots. That January, 8 valid setups appeared across 8 different markets that I was tracking, and every single one passed my analysis. My trading plan said, take 2. The first trade that month felt earned, a clean pin bar at a level that I had been watching for weeks. $30 risk, 2-to-1 reward target, it qualified. The second trade came a few days later on a different market, same quality and same setup. And that was my plan completed. 2 trades, month over. But the month was not over. The charts were still open. On a third market, another pin bar was forming at what looked like clean structure. The thought ran automatically at that point. It would be a waste of time not to take this trade. At that point, you are just rationalizing. I took the third, then the fourth. By the 5th trade, I was not even pretending to follow the plan. I was telling myself, I'll get back on track next month. This month is already blown. I was watching 8 markets at once, and every one of them was presenting setups that looked valid. 5 trades in 1 month against a trading plan of 2. My analysis was not the problem. And that's what actually made it worse, because every one of those setups looked reasonable on the chart. The problem was that my plan said take 2 trades, but contained absolutely nothing that prevented the third trade from happening. It was a wish written down, and wishes can't enforce anything. The plan needed a mechanism that refused the third trade before I could rationalize it. That mechanism has 2 parts. Before any trading setup earns one of your 2 monthly slots, it must pass 3 checks. Number 1, Is the trend confirmed? Open your higher time frame. If price is moving in a clear direction, the trend check passes. If it is choppy or unclear, the setup fails and the slot is refused. Number 2, is the price sitting at a predefined key level? This is the check most part-time traders skip. The level must already be on your chart from before the signal appeared. If you drew it this morning because the setup looks appealing, the check fails and the slot is refused. Number 3, is the entry signal itself clean? That is, a candle with normal range showing clear rejection at your level. If the trading candle looks several times larger than the average daily range, it fails and the slot is refused. All 3 checks must pass, and most of the setups that bleed part-time trading accounts fail at least one. The free diagnostic quiz in the description below identifies which check is your specific weakness. The link is right below this video. Check it out and get your diagnosis. Consistent trading execution is what keeps an account alive, and the filter is what makes that execution consistent when your brain wants to be flexible. Every setup that fails gets logged in what I call the rejection ledger. Date, market, which check failed, and then 30 days later, you record what the trade would have done if you had taken it. In 90 days, the trades you refused will prove more than the trades you took. But knowing the filter and running it under real trading pressure for 90 consecutive days are different tests. The first month with empty slots will feel like you are leaving money on the table. The months when your trading account sits empty might be the months keeping it alive. Jim Rogers managed money alongside George Soros, retired before 40, and built his fortune by waiting months between positions. He described his approach in one sentence. He said he waited until there was money sitting in the corner and all he had to do was walk over and pick it up. He did nothing else in the meantime. That nothing in the meantime is the part most traders can't accept. Rogers would sit in cash for months while markets moved, while signals appeared on charts, and while traders around him were active. And he waited. The man who co-founded the Quantum Fund could read markets better than almost anyone, but he waited because his trading edge lived in the selectivity. The setups that met his bar were so rare that most months produced 0 trades. And when one finally appeared, it was so obviously qualified that taking it felt, well, less like trading and more like collecting. Every week, the slots stay empty, and that emptiness is the mechanism working. But this one looks perfect. The weeks with 0 trades are your Rogers weeks. Your capital is sitting in the corner, waiting for a setup so clean that trading it feels obvious. And if a setup that almost qualifies but fails one of your 3 checks, it goes in the ledger and you close the chart. The hardest part of this drill is watching valid-looking setups pass you by and trusting that the ones you refuse are saving you more money than the ones you take. Step 1. Your slot cap. 2 trades per calendar month and printed where you see it before every session. If your slots are used, your month is done. Step 2. Run the 3 checks before any setup earns a slot. Is the trend confirmed, the level predefined, and the signal clean? If you have ever clicked into a trade knowing it was a marginal, this is the filter that would have stopped your hand. One failed check and the slot is refused. Step 3. Set up your rejection ledger. Every broker profits from every trade you place, regardless of your outcome. So every marginal trade you refuse is money the system does not collect from you. A simple spreadsheet with 5 columns: date, market, which check failed, signal type, and a 30-day outcome column that you fill in a month later with what the trade would have done. This column is the proof. Step 4. Run the drill for 90 days without changing the cap, the filter, or the tracking method. This part sounds easy until month 2, when the slots fill early and you are staring at setups 3 weeks because the month still has time left, but your slots don't. That pressure is the drill working. If you change the rules mid-experiment, the data is worthless. Your first action tonight is to open a blank spreadsheet, label those 5 columns, and write 2 at the top. That's your slot cap. Tomorrow morning, the first setup that appears gets run through the 3 checks. Passes all 3, it earns a slot. Fails 1, it goes in the ledger and you close the chart. But tomorrow morning, when you run the first check, trend confirmation for a currency pair is a different test from a trend confirmation for a stock index like NASDAQ. Apply the wrong version and the filter lets bad trades through. So watch this video next where I break down the filter that vetoes 90% of bad trading signals before they reach your shortlist. See you in that video.